Hey, it's Friday the 13th of September 2024, and it's time for the Million Portfolio. And even though it's Friday the 13th, it's been a good month, week, whatever you want to say for the portfolio. This is a special update for the Million Portfolio because it's the 36th monthly update. So it's been 3 years since I made this portfolio public. I kind of shared with everybody back in September of 2021 what my allocation, my thought, philosophy, asset allocation, all that. And it's been quite a ride. For a long time, the portfolio didn't do anything. Basically, it was either negative or just flat for like 2.5 years. A lot of that was due to the long-term bond allocation, just because the Fed was trying to fight inflation, so they were just raising rates at the quickest level that we've ever seen. So it was pretty crazy. But we're finally back on track, so let's go ahead and take a look at it. And then I'm going to share some of my thoughts on this 3-year anniversary special edition of the update. So as of market close today, we're sitting at $1.263 million in the portfolios. That's a little more than $1.25 million, which is great because I think the last update, we were just under 1.2 million. So in the last month, the portfolio gained $160,000, which is insane to say the least. The allocation, or I should say the intended allocation, which I'll put up on screen, is still the same, which is that we're going to go with 50% large cap growth. A little bit of that is going to be towards the leverage triple QQQs, 15% of that 50%. And then we have 25% in long-term treasury bonds. Again, we're going to use some leverage on that with the TMF, which is the 3 times leveraged long-term bonds. So I'm going to take that 25% and I'm going to split it 15% to TLT and 10% to TMF. 15% is going to be for large cap value. So we're using either O, Realty Income, which has its own crazy run in the last couple of weeks here. It made a new high for the 52-week period. So that goes to show you, how it's doing. So we're either using O, Realty Income, or SCHD, which is the Schwab Dividend ETF. But that 15% is basically the large cap value allocation. And last but not least, we have 10% gold to just help smooth things out. So let's actually take a look at the current allocation for this portfolio, which is completely out of whack. I know that, you know that, but it is what it is. So right now, I am sitting at some 62% to long-term bonds, whether it's just straight TLT or the triple levered long-term bonds TMF. And then the allocation to large cap growth is not that high. It's 14 and 7, so call it 21%. And then gold is woefully underallocated. But this is just a quirk of what happened this year. My attempt at market timing, I'll go a little bit into that. It all seems to have worked out, but yeah, not what I intended. But over the next 6 to 9 months as we head into 2025 and the interest rate inflation picture gets a bit clearer, I will definitely rebalance into the intended allocation. So I do want to give that caveat. This extra over allocation to long-term bonds, especially the triple levered ones, has contributed to the growth of the portfolio over the last, I say 2 months, quite dramatically. And we'll go look at the history of the performance just so that I can talk a little bit about it and why this particular allocation in the first place. So speaking of that, let's take a look at this particular public portfolio. It's not all of my accounts across Schwab, Fidelity, and other brokerages, but the other accounts are somewhat reflective of this philosophy. So it's not too off. But for this particular portfolio, you can see that we started on September 14 of 21. So let me go down a little bit here. September 14 of 2021 with just under $1 million, starting with this portfolio. And over the past 3 years, maybe even, gosh, 2 years of it, it hasn't done all that much. Even heading into the summer of this year, 2.5 years, it was just barely above, where we started at. The blue line is the $1 million portfolio, and the dash orange line is the S&P 500. And what you can see here over the last 3 years is that for about 2 years, it pretty much followed the S&P 500 for the most part. And then we had this downturn starting in the summer of 2023 when rates were just going way up. Long-term bonds took a dive, and the portfolio was underperforming the S&P 500 by a pretty big amount. And it continued that way for the next 9 to 12 months until bonds shot up just because people were thinking in early 2024. So my cursor right here is end of 23, early 2024. This is when people were irrationally exuberant and was thinking that maybe we're going to see up to 6 rate cuts. I mean, I think you all remember that narrative, right? So the portfolio just went way up at the beginning of 2024. Well, as luck would have it, everything kind of went crazy in early 2024. We saw small bumps of increases in inflation, and it got the Fed worried. And they basically didn't do anything. They didn't lower rates. They just kind of said, we're watching and waiting for what the data will show. And because of that, starting in April, the market tanked, but long-term bonds went deep, deep negative. And you can see it reflected by this sharp drop in the portfolio. And that was basically the time frame that I decided that this is crazy, right? We're not going to get 6 rate cuts in 2024, but we're getting rate cuts. Everybody acknowledged that inflation is now near what the Fed is targeting. It's going to take some time for rate cuts to actually take effect. So they're not going to wait until they see inflation at 2% before they're going to cut. If it was sitting at 3, they're already thinking about it, right? We know what's going to happen. So I felt like this overreaction in the long-term bond market was not warranted. And I fully confess that this is purely market timing for me. And as luck would have it, I was selling some options at this time on the NASDAQ holdings, and it got assigned. And instead of buying back into the NASDAQ and the gold, I went ahead and just basically placed it all on red or black. Take your roulette wheel metaphor as you see fit. But I basically took all the cash that I had at that point and went all in long-term bonds, and specifically on the leveraged long-term bonds, because I knew that by the end of the year, we're going to get a couple of rate cuts. Is it 1, 2, or 3? No one knows, but we're getting rate cuts. It's not going to be staying at 5.25% to 5.5% for the Fed's funds rate. And I felt that with all my being, and that's why I went all in on the long-term bonds, and that's why the portfolio is a little bit out of whack. Like I said, I fully admit that's market timing, but as you can see, as the market began to realize that this was going to actually happen, and you have to remember that the market is forward-looking, it shot up, basically went to the moon over the last couple of months. And it's to the point now where I'm actually doing better than the S&P 500 in this particular account by a very small margin, but it's finally doing better. And by better, I mean, had I taken the funds I started with and just put it in the S&P 500, I would have ended September with 1.257 million. I'm ending it with 1.263. Well, not end of September, you know what I mean, the update time for September. So it's not like I'm doing much better than the S&P 500, but it's a little bit better. And to even get here after being out in the wilderness for the last, 9 months, 12 months, it's a breath of fresh air. So I'm happy about that. The portfolio is a little bit kind of out of whack, but I'll bring it back to the proper allocation in early 2025, some point between first and second quarter, I'm guessing.
But that's where we are over 3 months. I do want to kind of take a step back and talk about like why this specific allocation in particular, where I have this large allocation of stocks to large cap growth, a little bit to large cap value, and then quite a bit to long-term bonds and that little bit in gold. The whole purpose of that is that I've been very lucky to accumulate a nest egg that's pretty decent. Not gonna lie, I'm very fortunate, but that means that it worries me if something were to happen. And I pivoted to this allocation because it's based on a risk parity allocation that I've researched, but I didn't feel like I was comfortable going towards that direction fully. So I tweaked it to apply to my own situation. And the specific risk parity allocation I was looking at was something called a golden butterfly portfolio from Tyler over at Portfolio Charts. This is based off of that, but like I said, tweaked. And the whole goal is to protect what I have so that if there was a severe drawdown, it wouldn't go down as much. That's the whole goal. So let's take a look over the long term for my entire account at Schwab, where this $1 million portfolio reside. And unfortunately, Schwab, the revamped version, only goes back to the beginning of 2017, even though I think my portfolio has been at Schwab since like 2010, right? But somehow after their revamp, historical data only went back to 2017 for all three taxable accounts that I have here. And if you look at this over the long term, so we're talking about, what is this, 7, 8 years? So 1, 2, 3, 4, 5, 6, 7 years, almost 8 years. When we get to the end of 2024, it'll be 8 years. You can see that the performance on an annualized basis over the last 7.5 years, almost 8, is not quite at the S&P 500 level, but it's pretty close, right? 13.19% annualized compared to 14.62. So not too far off. And if you were to look specifically, and I don't know how to stop it from popping up, but just want to illustrate what's going on. If you look at it over the last 6 years, it's pretty much tracked the S&P 500, but it doesn't have a lot of the sharp ups and downs, right? It's a lot more rounded and smoother. And that's the whole goal of this portfolio, was to get something like a high allocation to equities, maybe not a full 100%, but pretty high, call it 90-10, whatever. But with a lot less volatility, so that if things drop, it doesn't drop as bad, but then you give up a little bit of the gains. And for the most part, it was doing that for the first, call it 6 years. After 2023, you can see the divergence in this performance chart, right? The S&P 500 kept going up towards the moon, so to speak, and all three of my accounts at Schwab, including the $1 million portfolio, did not do as well. You can see finally the two are now converging again, but this is one of those once in a generation event, right? Usually you see long-term US Treasury bonds being negatively correlated to equities. And it's just in the recent 12 to 18 months that we had this positive correlation, which means that when stocks go down, the long-term bonds did as well, and went down pretty deeply. And that's why we saw this divergence. But now it's closing up again, which is where it should be. So my point in saying all of this is that if you are investing for the long term, expect some of these kind of weird one-off, moments for a year or so. But over the long, generation timeline, 20, 25, 30 years, you should get what the allocation has been back testing to. It's just that this has been super rare, and that's the way it has rolled out. So in any case, that's why this allocation. I'm happy that you're able to follow me on my journey with $1 million portfolio, and I'll see you on the next one, number 37. See you later. Bye.